Hi all, in this paper we're going to show you how to code a full paper from scratch. And so we're going to specifically start with three data sets. The first data set is CompuStat from 2018 to 2022. The second data is CRISP, which is 2018 to 2022. And the third data is the analyst earnings and sales surprises. So let's get into it. So this is what table one is going to look like. And so you can see we have the seasonal random walk earning surprise as one of our variables, and then like the summary statistics of that variable. We have the seasonal random walk sales surprise, and then the summary statistics of that variable. So table two is going to be a regression, just a simple OLS regression of the 3-day return on the analyst sales surprise and the analyst earnings per share surprise. And then table three is going to be a regression of the 3-day return on a value dummy. So that's if the firm is a value firm. Quarterly sales surprise, quarterly earnings surprise, quarterly sales interacted with their dummy, with their value dummy, and quarterly earnings interacted with their value dummy. So first we import the CompuStat data, as you can see here, and we're importing CompuStat 2018 through 2022. Next, we import the CRISP data, and we're importing the 2020 through 2022 CRISP data. And then this is going to be the sort of final table that we're going to run the regressions on, if you will. And this is sort of a sample table, so it includes Coca-Cola and it includes Pepsi. And you can see these are the variables we want: the data date, the earnings announcement date, the 3-day return, the seasonal random walk sales surprise, seasonal random walk earnings surprise, random walk sales surprise, random walk earnings surprise, analyst quarterly earnings surprise, analyst quarterly sales surprise, book to market, market value of equity, whether or not it's a growth firm or whether or not it's a value firm. And as you can see, if it's a value firm, it'll have one next to it. If it's a growth firm, it'll have one next to it. In terms of the seasonal random walk is basically just the seasonal random walk sales surprise is if you take, this, like, let's say you have Coca-Cola in the fourth quarter, right? And so Coca-Cola in the fourth quarter of 2021. So we would subtract off Coca-Cola in the fourth quarter of 2020, right? So Coca-Cola fourth quarter 2021 minus Coca-Cola fourth quarter 2020, and then divided by Coca-Cola um, sales in Q4 220. Um, and so, or 2020. And so that basically gives you, if you think about it, it's like basically what is the change in the sales from last year in the same, last year in the same quarter. And then seasonal random walk earnings surprise is what is the change in the earnings from a year ago in the same quarter, right? So if you're in the fourth quarter of 2021, this would be like, what is the change from the fourth quarter of 2020? By comparison, the random walk sales surprise is just what is it? What is the change in sales from one quarter ago, right? So literally, if you're in the fourth quarter, it would be of 2021. It would be the third quarter of 2021. So what is the change from the third quarter of 2021? And then similarly for random walk earnings surprise, it's what is the change from the third quarter of 2021 if you're currently in the fourth quarter of 2021. Analyst quarterly earnings surprise. This is like what were analysts expecting when you release earnings, and then what were the actual earnings, and then what's the difference scaled by the standard deviation of the analyst estimates. And then the analyst quarterly sales is what were the analysts expecting for your quarterly sales, and then what was the difference between what you actually released, and then all divided by the analyst standard deviation, or the standard deviation of the analyst sales estimates. Book to market is just the shareholders' equity over the market value, and this helps us produce, it helps us calculate whether it's a growth firm or a value firm. This variable together with the dividend yield, and then market value of equity is just what is the market value of the firm, and this is in millions. So as you can see, like Coca-Cola is a huge company, right? 235 billion, and Pepsi is a big company too, 204 billion. Okay, so this is ultimately the data that we want to calculate from the raw data, right? We want to get to this table so then we can run our summary statistics in table one, our regression table two, and our regression table three. So basically, we're going to show you how to go from raw data, raw CompuStat, raw CRISP, and raw analyst earnings surprises to this table or to this data, so we can then run our regressions. Okay, so first we want to clean up the CompuStat data. So we already imported it. Now we want to clean it up. And as you can see here, we like make the data date a date. We make the analyst or make the earnings announcement date a date, and then we all these other variables we turn into numerics, right? So CSHOQ is current shares outstanding. CEQQ is current shareholder equity. IBQ is the current income, like the operating income for the business. Sale Q is the current sales for the business in that quarter. PRCCQ is the current price, like at the end of the quarter. And then we, select, we clean up the industry format and the data format. We select only the rows where we have INDL or STD. And then lastly, we select we select only observations after 2020, or 2020 or after. Okay, and this is what the CompuStat data looks like that we read in, and after we clean it. And this is not all the data, but this is like the first, 10 or 12 rows or something. Now we want to clean up the CRISP data, and we want to get tickers and earnings dates from CompuStat. So we clean up the CRISP data by basically making the date a date, and then we get the list of tickers with RDQ dates from CompuStat. Now this is important because what we're doing here is we're getting ready to like create our main data set, and the main data set has an RDQ date in it, which is an earnings announcement date. And so we're going to select all the tickers with all the earnings announcements, and just those two, right? So we're going to have a CompuStat panel data of tickers and earnings announcement dates. And so that's what this looks like. It's panel data of ticker and earnings announcement dates for Coca-Cola and Pepsi, right? So this is like all of the earnings announcements dates for Coca-Cola, all of the earnings announcement dates for Pepsi after or between 2018 and 2022. Okay, now we want to get the tickers and the dates from CRISP, right? And again, this is important because this is like the main, data set. We're going to have CompuStat and we're going to have CRISP, and so we need to have all the firms from each. And so here, what we do is we get the list of tickers and the list of dates, and this is all the dates from CRISP. CRISP is Center for Research and Securities Prices. It basically is like all of the return data. And so first, we're just going to say, okay, let's get all the firms, let's get all the dates, and it's daily data. And the reason daily data is important is because we're going to, as you guys saw, we're going to calculate a 3-day return, and so we need to get all of the daily dates for each ticker. Okay, and it's going to look like this. For Coke, you can see it's starts on January 2nd, 2020, and it goes all the way through to like the end of to 2022, the current month in 2022. And for Pepsi, it does the same, right? We ran out of room, so we can't show you Pepsi, but Coke, goes from 2020 January every day to 2022, and then Pepsi does the same. Okay, so now if you think about it, what we want to do next is we want to merge. So this is the CRISP data. We want to merge in the CompuStat earnings announcement data, right? So we have these returns this data every single day, and then we're going to have the CompuStat quarterly data, and it's just going to be one observation per quarter, right? So we're going to have this CRISP data as our left-hand side table, and we're going to have the CompuStat data as our right-hand side table. So we're going to end up with every single date when we do a left join. And then on the right-hand side, it's just going to be one observation per quarter. And I'll show you that in a second. So left join the tickers and dates from CRISP with the earnings dates from CompuStat. Okay, and so what we want to do is we're doing a left join. And again, CRISP is on the left-hand side. CompuStat's on the right-hand side. CRISP is daily. CompuStat's quarterly. So we're going to have the left-hand side every single day. And then on the right-hand side, we're going to have just, one observation per firm per quarter. And we're matching on ticker and we're matching on saying, okay, the date from Crisp should match the date of the earnings announcement. Okay, and then we're ordering by ticker and by date. And so as you can see, for Coca-Cola, we have the returns every single day, and we have the earnings announcement just from the quarter, right? And this data got truncated, but this should go all the way from 2020 to 2022 for both Coke and Pepsi. And you can see how the data is. And it's critical that we put the crisp data on the left and the CompuStat data on the right. So we have, every day um, of crisp data, and then we have the relevant days, the relevant earnings announcement dates. If we did the CompuStat earnings announcement data on the left and crisp on the right, we would only have the quarterly data, uh, and the one day from each, uh, the one date that corresponded to each earnings announcement date. But that's not what we want. We want literally every day from crisp, and we want each quarterly announcement date. And the reason we want that is so that we can then use the 3 days after each earnings announcement to calculate the 3-day return after the earnings announcement. So that's why we structure crisp on the left, CompuStat earnings announcement on the right, so we can capture these 3 days after the earnings announcement. Okay, so now we want to keep only the rows 3 days after the earnings date. So what we do here is we use this shift function, right? So first we sort by ticker and date, right, which gets us exactly what we want here, right? So we have ticker, Coca-Cola, and then date, and it goes, the January 2nd, January 3rd, January 6th, January 7th, right, all the way. It's ordered. And if anyone wonders why, January 4th and January 5th are missing, that's because those are weekend dates, right? Weekend markets aren't open on weekends, and so it's not in the crisp data. Okay, so now what we want to do is we want to say, okay, we want to get rid of all of these dates and just keep the earnings announcement date and the 3 days after each earnings announcement date. And so what we're going to do is we're going to shift this RDQ forward 1 date, forward 2 dates, and forward 3 dates. So we're going to have RDQ1, RDQ2, and RDQ3. Right? RDQ1 is going to be equal to the next day after the earnings announcement. RDQ2 is going to be equal to the 2 days after the earnings announcement. RDQ3 is going to be equal to 3 days after the earnings announcement. And so that's what we do with this shift thing. Shift 1, shift 2, shift 3. We're just shifting it, 1 day after, 2 days after, 3 days after. Then what we do is we calculate the 3 days after the earnings date. And so if the earnings is after hours, then we use all 3 dates, because then, right, the first day the market will know, the first day the market will be able to trade the earnings announcement is the day after, right? If it's an after hours thing, they can't trade it after hours, so they'll only be able to trade it these 3 days. If the earnings announcement was during the day, then they'll be able to trade it during the day and the 2 days after. So the 3-day return will be that day and the next 2 days. So if it's after hours, it's the next 3 days. If it's during the day, then it's that day and the next 2 days. And so that's what we do here. And we say, we have this. Okay, and now what we do is we say, okay, what we want to do is we only want to keep the rows in this table where RDQ1 is not blank, RDQ2 is not blank, and RDQ3 is not blank. So basically, we only want to keep, this date, this date, this date, and this date. And so here's what we have. So what we end up with is, as I told you, RDQ plus 1 is going to be the day after the earnings announcement. RDQ2 is going to be the 2 days after. RDQ3 is going to be 3 days after. And then what we in this right here, what we did is we dropped everything where RDQ plus 1, RDQ plus 2, or RDQ plus 3 was blank. And so that got rid of all of these rows, other than just this one, this one, this one, and this one. And so as you can see that we've got Coca-Cola with just the 3 days after each earnings announcement. And now, okay, so we have all this, and so okay, now what do we want to do? Well, you can guess what we're going to want to do is we're going to add in the returns, right? Because these are the 3 days after each earnings announcement. So now we want the returns for each day after each day for the 3 days after the earnings announcement. And then what we're going to do is once we have the returns for each of the 3 days, we're going to accumulate those returns, and we're going to then say, okay, the 3 day return after the earnings announcement is equal to this return times this return times this return, and that 3 day return is going to be in the same row as the original earnings announcement. And the reason we want it to be in the same row is because, as you can remember, with the data we're trying to get to this, right, the 3 day return, this is a cumulative return, and this is the earnings announcement, right? And the reason you want to have all of the data together is so you can then run a regression of 3 day return on, the seasonal random walk sales surprise, or 3 day return on the analyst earnings surprise, or whatever. But in order to run that regression, you need the 3 day return to be in the same row as the earnings surprises and the sales surprises. So um, that's why we're going to merge in the return now here, and then we're going to take the 3 day return and take it back to here. Okay. So next we add in the return data as I described. And so what we're doing is we're taking this table, and then we're going to left join the return data, right? So we have each date, and then we're going to left join in the return data, and we're going to match on ticker and date, right? So we want for each ticker and for each date, what was the return that day? And so we'll have this data set as our left hand side table, and our right hand side table will be crisp, just the ticker, the date, and the return. And so as you can see, that's what we did here. We have ticker equals ticker, and we have the date equals the date, and you can see this table here. The first line here corresponds to this table, and then the second line here corresponds to the crisp data 2022 to 2020 to 2022, the daily crisp data. And then as you can see here, we left join this table on the crisp daily return data, and we add in the crisp return. Okay, if you have any questions on left joins, please watch my video on left join, how left joins work. Okay, so as you can see now, sure enough, we have the return data. And what we did was we only kept the ticker column, the date column, the RDQ column, and the return column. So we didn't keep these RDQ plus 1, RDQ plus 2, RDQ plus 3. We dropped these rows and just merged ticker, date, RDQ, and return. And so that's what you see here: ticker, date, RDQ, and return. So the question is, what's next? Well, what's next is, as I said, we want to accumulate these 3 returns, right? This return, and this return, all the way back to here. So we then have a 3-day return variable, and that's equal to these 3 accumulated. Okay. And for the purposes of this paper, we're going to assume that every firm releases earnings after hours. So therefore, the 3-day return we want is the next day, 2 days later, and 3 days later. And then we accumulate them, bring them back, and that's the 3-day return. Okay. So sure enough, we do that. And that brings us this return. And you okay. Well, all right. So that is So this is the code that gives us the 3-day returns, right? And the shift 1 allows us to get the next day's return. Shift 2 allows us to get the return in 2 days, and then the shift 3 allows us to get the return 3 days from now. And then what we do is we multiply 1 plus tomorrow's return, 1 plus 2 days from now's return, and 1 plus 3 days from now's return. And that gives us the 3-day return if earnings is after hours. And so, ta-da, we've accumulated the 3-day returns. And now you can see 3-day returns if earnings is after hours. And we have that all here. And so this got truncated, but this would, on the left hand side over here, out of the screen, which you can't see, is ticker, date, and then the 3-day return for each date. Okay, but we in the meantime we had skipped some slides, so let's just go through the two slides that we missed. So before we run the cumulative returns, the cumulative 3-day returns, we want to add in the CompuStat fundamental data, which includes sales, dividend yield, income, um, fiscal quarter, fiscal year, that kind of stuff. Shareholder equity, shares outstanding, and price. And so what we want, so now we have this on our left, right, which is basically a crisp with the RDQ, with the earnings announcement date. So this is basically crisp, plus we have the earnings announcement date within this data. So we have this on the left-hand side. Now we want to left join the sales, income, shares outstanding, shareholder equity, and price data from CompuStat. So again, we're going to rely on our old friend left join, and we have this ticker and we have this date. And so we want to match on ticker, match this table to the CompuStat data on ticker and on date. And so let's do that. So as you can see here, this Chris CompuStat 2020-2022, that corresponds to this table, and then CompuStat 2020 through 2022 CompuStat corresponds to our CompuStat table. And so sure enough, we're going to add in dividend yields year to date, sales year to date, income, like operating income year to date, fiscal year quarter, uh, fiscal quarter, fiscal year, shareholder equity, shares outstanding, and the price. Okay, and again, we're merging on ticker, and we're merging on this date RDQ. And so why do we merge on RDQ and not this? Well, the answer is because the RDQ came from CompuStat. So each row in CompuStat has an RDQ variable, and it also has a ticker. So like this is a one-to-one match between ticker RDQ in this table and ticker and RDQ in CompuStat. And so that's why we merge on ticker and RDQ. Okay, and this is what we get. So this is dividend yield, this is sales, this is income, this is fiscal quarter, fiscal year, shareholder equity, common shares outstanding, and price, right? And as you can see, because we merged on RDQ and ticker, we only have the CompuStat data for the rows that also have RDQ. Okay, and this is fine. And then in our next action is going to be to go and accumulate these three days of returns, and then so we'll also have a variable that's in this row that's 3-day returns, right? And the 3-day return variable is going to say what is the 3 days, what is the cumulative return over the next 3 days after the earnings announcement. And so here it is, cumulative 3-day return. Again, we add in the cumulative 3-day return data. And so now this table became too big, but basically all this is this plus this, right? So for each, and then meanwhile we dropped on. Yeah, and then we drop the rows. We only keep the rows with an earnings announcement. So here is we select all of our variables, right? Everything RDQ, return, data date, all the things we have from CompuStat. Return 1, return 2, return 3, 3-day return if earnings during the day, 3-day return if earnings after hours, and then we drop any variable where the earnings announcement is empty. And so we only keep the rows where the earnings announcement's full. So if you go back and look at this data, we only keep the earnings. We only keep where there is an earnings we only keep the rows with an earnings announcement, and we drop everywhere where the earnings announcement is blank. So as you'll see, all of these rows, everywhere the earnings announcement is blank, we're going to drop those rows, and we're just going to keep the earnings announcement rows. and we're going to have the 3-day return here. The reason we can drop all the places where there's not an earnings announcement is because we no longer need these returns, these 3-day returns, and the reason is because we now have a variable called 3-day return, which is equal to these returns cumulated. So we no longer need this data because we have a variable which tells us what the return is over the next 3 days. Okay, so this is the code that keeps only the rows with an earnings announcement, and then sure enough, this is what it looks like. And as you can see, we only have rows with an earnings announcement, and this is showing the CompuStat data, but there's also a 3-day return variable over here. It's just cut off because it couldn't fit into the screen. But so there's all the CompuStat data, there's the ticker, there's the date, and then there's a 3-day return variable right here, which is just cut off. And that corresponds to what was the cumulative return over the next 3 days for each earnings announcement. Okay, so now what we want to do is, so this is though for 2020, right? 2020 to 2022, and you can see it's for Coke and Pepsi. But now what we want to do is we want to create a table with the 2019 data and the same columns. So why do we want 2019 data? Well, as it happens, we need to figure out like what was the 4 quarters ago sales, what was the 4 quarters ago income. And the reason we need to figure those things out is because we need to calculate the seasonal random walk for sales and the seasonal random walk for income. And in order to do that, we need 4 quarters ago. We need to know what the sales was for Coca-Cola 4 quarters ago. And so if we get 2019, then we'll have 2019 0130. What was the sales during that time, and what was the income for Coke in 2019 130, right? And then we can use that sales 4 quarters ago and the income 4 quarters ago to calculate the seasonal random walk. So that's sure enough, that's what we do, right? We pull the dividend yield, we pull the sales, we pull the income from 2019, and we're going to use that to calculate year over year change in sales, year over year change in income, which is known as the seasonal random walk of sales and seasonal random walk of income. To do that, we set the fiscal year equal to 2019, and this pulls all the 2019 data. And we order by ticker and order by data date. So it's going to be a list of all the tickers like Coke, and then 2019 quarter 1, 2019 quarter 2, 2019 quarter 3, 2019 quarter 4, and then I'll go like Pepsi, 2019 quarter 1, 2019 quarter 2, 2019 quarter 3, 2019 quarter 4. And sure enough, that's what we have here, right? So we've got Coke in 2019, and so why is it 2021 30? Well, the reason for that is because this earnings announcement corresponds to the 4th quarter of 2019. And as you can see here, the data date 2019 12/31. So this is describing what happened in the 4th quarter of 2019. Okay, and so we have all of this. So now what we need to do is we need to append this 2019 data to our 2020 to 2022 data, so we can then use this sales data and this income data to calculate year-over-year sales and year-over-year income, also known as seasonal random walk, for our 2020 data. So sure enough, next we append the CompuStat 2019 data to the main table, and the main table is our 2020 to 2022 data. And so as you can see that here, it's just table 2019 dot append table 2020 to 2022. And to make it easy to understand, I renamed our table, our 2019 data to just be equal to table 2019, and I renamed our data set from 2020 to 2022 to be 2020 table 2020 to 2022. Okay. And then so I do, table 2019 dot append table 20 to 2022, and that gets us the table 2019 to 2022. And as you can see, I then sort it by ticker and data date. Okay, so here we have it. We've got Coca-Cola in 2019. We've got Coca-Cola in 2020 and 21, and even the first quarter of 2022, which or the earnings announcement from the first from February of 2022, which corresponds to the end of the fourth quarter of 2021. All right, so now we basically what I'm saying is we have all the data here together, right? And what you can't see here is we still have a 3-day return here, which is just outside the frame, but that column is in this data set. Okay, so now what we need to do is we need to calculate, change in sales from a year ago and change in income from a year ago. When now we have all the data, we can do that. But before we're going to do that, we're going to add in market value of equity and book to market. So the market value of equity is just the shares outstanding times the price, and that gets you market value of equity. And the book to market is shareholder equity divided by market value. So as you can see, CEQQ, which is shareholder equity, that's basically total assets minus total liabilities, and that's basically the book value of the firm over the market value, which is shares outstanding times the price. And so we want to then merge that back in, and so we merge in market value of equity and book to market into our data. And so this is our data, and we have, as you can see, we have this 3-day return here. We still have 3-day return data, and then now we also have market value of equity and we have book to market. And as you can see, this is we just, because we had shareholder equity, shares outstanding, and price, we were able to construct book to market and market value of equity using these 3 variables. As you can see here, we constructed these book to market and market value of equity. Okay, so we have that there, and this is just the right hand side of this, right? Because we couldn't, the screen wasn't big enough. So this is all the same table as this table. This is the right hand side of the table. Okay, so next what we do is we rank the book to market for all companies at each fiscal quarter date, and then delineate the first third from the last third. Why do we do this? The answer is the following. We do this because we need to know, in order to know what a value firm is and what a growth firm is, it's based off book value and or it's based off book to market. So value firms are book to market. So are the firms that are in the bottom third book to market, and growth firms are in the bottom third book to market and do not have a dividend yield where the dividend yield is in the top quartile, so the top 25%. By comparison, value firms are firms which have the top third book to market in any given time and have a dividend yield in the top 25%. Those are value firms. So I'll just say that one more time to make it clear. So value firms have a top third book to market, meaning their book to market at any given time is in the top third of all firms, and their dividend yield is in the top 25% for all firms, though it's value firms. Growth firms are bottom third book to market, so book to market that's in the bottom third of all firms, and their dividend yield is not in the top 25% of all firms, right? And so in order to calculate the value firm versus growth firm, we need to have the first third percentile and last third percentile for book to market. And so here's how we do that. We select all the data where book to market is not blank, and then what we do is we have this percentile variable, and we say book to market 2019 through 2022, group by data date and book to market. The reason we group by data date is because for each quarter we want to know for each time period from CompuStat, we want to rank all the firms by book to market, and then give them a percentile, right? And so if they're in the bottom third percentile, then they could possibly be a growth firm so long as their dividend yield is not in the 25%. Or if they're in the top 60, 67 percentile or above, then they could be a value firm if if they also have a dividend yield that's in the top 25%. And so this is the code we use to rank the firms and then calculate the percentiles every day to day. And that's what you see here: first third, last third, right? And this last third is key because that's actually both first third and last third are key, because last third is how you calculate the potential for value, and first third is if it's in the first third, then it has the potential to be growth so long as dividend yield is not in the top 25 percentile. Okay, so you can see that all here. Next, we rank the year-to-date dividend yields for all companies at each fiscal quarter date and delineate first and last quartiles. So again, the reason we do this is because we remember the definition of a value firm is its book to market is in the top third of a book to market, and the dividend yield is in the top quartile. And by comparison, for value firms, its book to market is in the bottom third, and it doesn't have a dividend yield in the top quartile. So in order to do this, in order to make the calculation for whether or not a firm is a value or a growth or neither, we need to also have the dividend yield quartiles. So now we have that, right? We have first quartile, and this is first quartile dividend yield, and fourth quartile dividend yield. So you can see, there are some firms that are in the first or the fourth quartile of dividend yield, and so we list that here. Okay. Next, we merge the book to market data back into the main table, and we merge the dividend yield data back into the main table. And so we have book to market last third. So this would be like value firms, so long as the dividend yield is also in the first quartile. So if the book to market is in the what is it? If the book to market is in the last third, so that means it's the firms with the most book and the relatively least equity, that would be value firms, so long as the dividend yield is in the first quartile. So the fourth quartile, because these are the firms that pay the biggest dividends. Right. So first quartile is 0 to 25%. So this is the firms that pay the least dividends. Fourth quartile is 75 to 100. So these are the firms that pay the biggest dividends. So what we want is the firms with the biggest book value relative to market value, and the firms that pay the biggest dividends. So as you can see, this one here is a value firm because it's got top third book to market and top, and biggest quartile dividend yield. And then we don't see any value firms here. Value firms would be book to market in the first third and not a dividend here. Okay, next we add year ago quarterly sales and income. I told you a while back that we were going to do that, and now we're adding year ago quarterly sales and income. So in order to do that, what we do is we do our friendly shift 4. You guys remember 4, which is this is 4 quarters ago sales and 4 quarters ago income. And then what we do here is we check to make sure that the fiscal year -1 equals the fiscal year from a quarter ago, right? So if our current fiscal year is 2021, and then 4 quarters ago would have been 2020, right? And so fiscal year -1, so 2021 -1 equals 2020. So so when we say if this is not true, right, then we want this to be blank, because this is like an error check. So we want to make sure that 2021 -1 equals 2020. And then for this, what we want to do is we want to make sure that these are supposed to be equal, right? If we're in the fourth quarter now, then we should be in the fourth quarter 4 quarters ago. But if this is not equal, then it's blank. So this is basically our error checking. And we do the same thing for this 4 quarters ago income. And so basically, like if it doesn't correspond, or this doesn't correspond, then we set 4 quarters ago sales equal to blank, or 4 quarters ago income equal to blank. Otherwise, if these are correct, then we keep the 4 quarters ago sales and we keep the 4 quarters ago income. And then, so sure enough, we add it into our table, and here you can see 4 quarters ago sales, 4 quarters ago income. And in general, it's good to do these sort of error checks to make sure that this 4 quarters ago sales does correspond to the sales 4 quarters ago. Next week, and so this was for the seasonal random walk, right? And now we want to add in quarter ago sales, and this is just for the random walk, right? Where we say what were last quarter sales, what was last quarter's income, what is this quarter's sales, what is this quarter income, and then look at the difference. And that gives us our random walk of sales and a random walk of income. And so now, instead of shifting by 4, we're just shifting by 1, because we're just going back 1 quarter instead of 4 quarters. And again, we run this sort of error checking to make sure that we're in the right, that we're getting the right sales data, that is sales 1 quarter ago, and we're getting the right income data, which is income 1 quarter ago. And you can see this error checking is basically saying that the fiscal quarter here should equal 1, or if the fiscal quarter here equals 1 and the fiscal year is 1 quarter ago, then what we want to do is we want to, right, this is the case where it's like we're talking, the first quarter of the year. So then the year ago sales would actually be the year behind. Let's say it's 2021 first quarter. Then the quarter ago sales would actually be 2020 Q4, right? 2020 Q1 and 2020 Q4. So this is checking to make sure that in that case that's true. If it's not true, then we give it a blank, and we do that same thing here. And so, right, this is why if F quarter equals 1. So if it's in the first quarter, we do this check. Now, if it's in the second quarter, third quarter, or fourth quarter, then 1 quarter ago is going to be same year, but just like quarter 1 or quarter 2 or quarter 3, depending. Right. So if it's 2021 quarter 2, then 1 quarter ago would be same year. 2000 would be the same year and just quarter 1. And so we do run the check to make sure that that is how it is. If that's not how it is, and we somehow the calculation was wrong, then we set IBQ 1 quarter ago equal to blank, and sales 1 quarter ago equal to blank. Okay, and now we just did that, and so now we have sales quarter, Q underscore 1. This is sales 1 quarter ago, and this is income 1 quarter ago. Okay, next we drop all rows with blank year ago and quarter ago sales and income. So this is basically saying, like, if there are any rows that don't have, filled in 4 quarters ago sales or 4 quarters ago income, or they don't have 1 quarter ago sales or 1 quarter ago income, then we want to drop it. And the reason we want to drop it is because when we need all of our rows in our final table. Remember, this is our final. Where is that? This is our final table. So we need all seasonal random walk values to be populated, and we need all random walk variables to be populated. And these can only be populated if we have 4 quarters ago sales, and we have 1 quarter ago sales, 4 quarters ago income, and or 4 quarters ago earnings, and 1 quarter ago earnings. And so in order for every row to be populated, we need to have the 4 quarters ago and 1 quarter ago data. And that's why we drop 4 quarter ago data and 1 quarter ago data if they're blank. Let's go back to where we were. Yeah. So if the 4 quarters ago or 1 quarter ago data is blank, then we drop it. And so that leaves us with this, where we have 4 quarter ago number and a 1 quarter ago number for every sales and every income. Boom. Okay. Next, we add in whether the firms are growth firms or value firms. And so this is where we say, okay, if book to market is in the first third and dividend yield is not in the fourth quartile, then we say it's a growth firm. If book to market is in the last third, right, so it has relatively big book to market, and dividend yield is in the last quartile, then it has a relatively big dividend yield. Okay, it's a value firm. Okay, so now we define growth firm and we define value firm. Okay, so now each thing is here: growth firm, value firm. And as you can see, remember we were doing this for Coke, right, and Pepsi. And so what this is saying is that basically Coke is a value firm, right? This is the right hand side of this table, uh, and it also has 3 day return and all that, but that didn't fit on it because this is like the furthest most right, and this is the furthest most left, and there's still sort of a middle part which you can't see here because it was truncated. But regardless, all right. So this is saying that Coca-Cola in these 5 quarters, each quarter is a value firm, and Pepsi is neither a value firm nor a growth firm. Boom. Okay. Next, we add seasonal random walk, sales surprise, and earnings surprise. So as I mentioned, seasonal random walk is this quarter minus 4 quarters ago divided by 4 quarters. So this is basically change in sales from 4 quarters ago to this quarter, change in income or earnings from 4 quarters ago to this quarter, and it's sort of scaled by income 4 quarters ago and sales 4 quarters ago. Okay. So as you can see here, now we have seasonal random walk sales surprise and seasonal random walk earnings surprise. And these are basically like, you can see this is like 5%. It's not percentiles multiplied by 100, but it's 0.05, which is so negative 5%. So here, Coke's sales went down by 5%. And here their earnings from a year ago went down 28%. Okay. And then, in the third quarter, 3 quarters later, their seasonal random walk sales grew by 41% and their earnings grew by 48%. Okay, next we want to calculate random walk. So this just compares a quarter ago to this quarter. And so as you can see, it's sale Q minus 1. So sales this quarter minus sales last quarter over last quarter sales, or income this quarter minus income last quarter over last quarter income. And sure enough, now we have random walk sales surprise and random walk earnings surprise. Okay. So we're getting close to what we want, right? Which is to have, say seasonal random walk populated for all the sales, seasonal random walk populated for all the earnings, random walk populated, and for random walk sales populated, random walk earnings populated, right? Okay. Now we want to add in the quarterly analyst. So this is basically to what extent do firms, beat or miss their analyst sales expectations and their analyst earnings expectations. Okay, and so what we're going to do here is we're just going through the analyst sales data and analyst earnings data, and we're basically pulling it out for each month, right? This is January, this is February, and this is February if it has 29 days, or it should be February if it's 8 days. Sorry, this should be 28. Because this was a leap year, which has 29 days, and this is so this should be 28. So I'll change that in the code. You should change that in your code. Otherwise, all these are right. March has 31 days. April has 30 days. May has 31 days. June has 30 days. July is 31. August 31. September 30. October 31. November 30. December 31. So the only number here that's wrong, this should be at 28, because that, after 2020, 21 and 22 are both 28 days in February. Okay, and that basically, so now this gives us, you can see here, the SUE score. So this is to what extent the firm beat their quarterly EPS. EPS is earnings per share. So here you can see they beat it by and so what they take is they take the EPS data, they subtract off the actual, and and then they divide it by the standard deviation of all the analysts. And so that's the SUE score. And so that's for EPS. Now, if you go further down in this table, they also have sales. And so this would be the sales for SUE score is um, what was the actual sales minus what did the analysts expect sales divided by the standard deviation of the analyst estimates. And that gives you SUE. Okay. So now we want to merge in that analyst quarterly sales and income surprises. And this is our earnings surprise, but then further down in the spreadsheet, there's a sales, and that'll be our sales surprise. So we want to merge in the analyst quarterly sales surprise and analyst quarterly income surprise. And so we merge it in, and here we go. We have quarterly EPS, so that's quarterly earnings surprise. So this is, again, what were analysts expecting, what were their actual earnings per share, and then what was the standard deviation of analyst estimates. And that gives us this quarterly earnings surprise. And quarterly sales surprise is what was actual sales, what were analysts expecting, and then what was the standard deviation of analyst estimates for sales. Okay, next we merge. So now what we want to do is merge in this data into our main data. And so you can see we did that here. We've got our SRW, which is seasonal random walk for sales, seasonal random walk for earnings, seasonal random walk for sales, random walk for earnings. And now, sure enough, we also have our analyst earnings surprise and our analyst sales surprise. So we're getting quite close. And you can see our book to market is all filled in, our market value is all filled in. So now we're getting quite close to having like our regression table, our table that we can use to run regressions, calculate summary statistics, etc. So last thing we want to do is we want to drop inf. So what is inf? So occasionally, like if you have if you divide by 0, or if you have a NaN, which is it's blank, you know what I mean? We want to drop any value. So like for example, if quarterly earnings somehow grew to infinity, right? If the earnings per share surprise was infinity, that would mean not that the company's earnings grew infinitely or beat analyst expectations infinitely. It would mean like the standard deviation would, right? The standard deviation of analyst earnings estimates, which is the denominator for this variable, would be 0. And so, and then we would get an inf, which basically means infinity. So what that means is we don't want that data, right? Because it's going to throw off our numbers, and it's not even correct. It just means that we don't have the analyst estimates or the standard deviation of the analyst estimates. So what we want to do is we're going to throw that variable out, or throw the row out, right? Like throw this observation out if this is an inf. And so this code allows us to do that. It's replace all the rows that have an infinite value in it or a negative infinite value with NaN. NaN just means blank. And then what we say is drop Na. So now that it's blank, okay, well now, so we replaced infinite, positive infinity, negative infinity with NaN, which means blank. And now we say, okay, we want to drop any row that has a blank value. And so this allows us to flush the rows with infinite values and the rows with negative infinite values. Okay, so next we calculate summary statistics for all firms. So we're really getting close here. And as you can see, this got truncated, but it starts out with the summary statistics for earnings surprise, for seasonal random walk earnings surprise, summary statistics for sales surprise, summary statistics for random walk earnings surprise, summary statistics for random walk sales surprise. And then sure enough, as you guys saw, there's more, right? Like we need the summary statistics for book to market. We need the summary statistics for market value of equity. We need the summary statistics for analysts earnings per share beat. And we need the summary statistics for analyst sales surprise. So this is analyst earnings surprise. This is analyst sales surprise. So we need the summary stats for those two. So anyway, if you go further down, it's basically going to be the same thing, except instead of being seasonal random walk earnings surprise, it'll be like analyst quarterly earnings surprise, or analyst quarterly sales surprise, or book to market, or whatever, or the other variable is market value of equity. So anyway, that gives us, and then we, so as you can see here, sure enough, that's what we did, right? Quarterly. This is This is the second half. This is the second half of this. And so, sure enough, we have the summary statistics for 3-day return, summary statistics for quarterly analyst earnings surprise, summary statistics for quarterly analyst sales surprise, summary statistics for book to market, summary statistics for market value of equity. And what are the summary statistics, you might ask? Well, it's the minimum, the 10th percentile, the 25th percentile, the 50th percentile, the 75th percentile, 90th percentile, and the max, right? And so we're getting each of those numbers for each variable. And that what that does is that just helps us understand the distribution of each variable. And then this is what it looks like if you print it out, right? So this code will give you this. So it'll tell you the minimum of this seasonal random walk is this, the maximum is this, the 10th percentile is this, 90th percentile is this, etc. And so, and then again, this got truncated, but it'll print it out for everything here. And then what you do is you want to take those numbers and you're going to plug those you're going to put those numbers in to your table one, right? Your table one where it says like what is the minimum of this variable, what's the minimum or the 10th percentile of this variable, what's the 25th percentile of this variable, right? So you want to take all these numbers and you want to put them in to your table one. And so these numbers are your table one. Okay, now your table one panel A, which is summary statistics for all firms. Now you want the summary statistics for all value firms, right? This is like a subset of the data. And so we have to run all this again, right? We select where value firm equals 1, and now we run the summary statistics for all the same variables, but just where the value firm is 1. And you can see that. So this is here. This is here. You can see the summary stats for all the variables. And then, sure enough, it prints it out. Summary stats for all the value firms, and then for each variable. And again, it got truncated here, but in your code, when you run your own code, it'll print out everything. And then what you do is you take each of these numbers and plug them into your table one. Or sorry, table one panel B, which is going to be summary statistics for all value firms. And table one panel A is going to be summary statistics for all firms. And then we leave it to you as an exercise to calculate summary statistics for all growth firms, which will be your table one panel C. But it's actually relatively easy. You just use this code. Instead of saying value firm equals 1, you do where growth firm equals 1. And then all this other code is the same. And it'll print you out something that looks like this, except it'll be summary statistics for growth firms. Okay, and again, you take all this data and you plug it into your table one panel C, which is for growth firms. Okay, next we Windsorrize the variable. So Windsorrize means we drop the first, anything that's the first percentile below or 99th percentile below. And so the reason we do this is we want to drop the extreme outliers, right? And why do we want to drop the extreme outliers in our data? Because it throws off our regressions, right? If you have some firm that has super high year over year sales growth, like 1 trillion% sales growth, we want to throw that out. And the reason we want to throw that out is because that's not representative of the full sample. It'll way throw off our data, and it's not. It's probably because of some data error. And so here what we do is we, calculate the quarterly earnings. So this is the analyst quarterly earnings surprise, and we drop anything that's below the first percentile, and we drop anything that's above the 99th percentile. And so here, specifically here, what we're doing is we're saying, this is the first percent, we're creating a new variable, first percentile, 99th percentile. And then here we have, we basically say first percentile equals 0 if it's, if it's more than 1 and less than 99. And here 99th percentile equals 0 if it's more than 1 and less than 99. Okay. Now we Windsorrize more variables. Now the 3-day return variable. So here we Windsorrize the quarterly earnings variable. Here we Windsorrize the 3-day return variable. And we should also Windsorrize the quarterly sales. So if that's not here, and it actually, so these are two slides. So this is quarterly earnings. This slide should be quarterly sales. And then this is the winterizing the 3-day return. In order to winterize quarterly sales, though, you would just change this to, instead of QDR EPS, you'd have this QTR sales. And this would be QTR sales here, sales here, sales here, sales here. And this gives you the first percentile for sales, 99th percentile for sales. And here, it sets it equal to 0 if it's not in the first percentile. Sets it equal to 0 if it's not in the 99th. Okay. And now we winterize the 3-day return data, as you can see here. And then what we do is we select everything where the first percentile and the 99th percentile is not equal to 1. Right? Do you see how, like, for 3-day return, where first percentile doesn't equal 1, 99th percentile doesn't equal 1. Earnings, 99th percentile doesn't equal 1. Earnings, first percentile doesn't equal 1. Sales, first percentile doesn't equal 1. Sales, 99th percentile doesn't equal 1. So in effect, what we're doing is dropping all those rows that are, in the first percentile and 99th percentile. Next, we run a regression of the 3-day return variable on analyst quarterly earnings and sales surprises. And as you can see here, what we do is we get rid of the infinite values. There shouldn't be any, but we just double check here. We keep only the 2020 data. And by keeping only the 2020 data, it means we keep the variables that have, after 2020. But it's day to date after 2020. But the 4 quarters ago sales are still going to be in 2019. But we're just keeping with the day to date after 2020 or 2020 and after. And then, now we regress 3-day return on quarterly sales surprise, analyst quarterly sales surprise, and analyst earnings surprise. And then we print out here the results of the regression. And sure enough, you can see 3-day return is the dependent variable. And then the intercept is this. The quarterly sales surprise is this. And this is analyst quarterly sales surprise. Analyst earnings, quarterly earnings surprise. So you can see this. This is our T-stat, 4.362. This is statistically significant at the 1% level. As you can see, 0.000 is less than 0.01. So this is statistically significant at the 1% level. So this would get 3 stars. This is statistically significant at the 10% level. So it would have 1 star. Right. And this basically means if you beat analyst expectations, then you're going to have a positive 3-day return. And that is the positive 3-day return is statistically significantly different from 0. And then similarly with the quarterly sales surprise, if the 3-day return, it's if you beat the sales estimates, you're going to have a positive 3-day return. It's going to be statistically significantly positive, but only at the 10% level versus at the 1% level for earnings. Now, why is this? This means that basically firms care relatively more, for all firms, what this is run on, not value, not growth. This is all firms. Then, they appear to care relatively more about earnings than sales, which is not to say they don't care about sales. It's just to say they care relatively more about earnings when it comes to 3-day return. Okay, next run a regression of the 3-day return variable on a value firm dummy. So that just means 1 if it's a value firm, 0 otherwise. Analyst quarterly earnings surprise, analyst quarterly sales surprise, analyst quarterly earnings surprise interacted with value, dummy, analyst quarterly sales surprise interacted with value. Okay, and so in order to do this, we need to create a dummy variable. This is equal to 1 if it's value firm, 0 otherwise. This variable is the same. Sales quarterly surprise is the same. Sales earnings quarterly surprise is the same. This is analyst quarterly sales, analyst quarterly earnings surprise. And then we interact each of these variables with the value dummy. So it's like, multiply times 1 or 0. If it's value firm, multiply times 1. If it's growth, multiply times 0. All right, we run the regression of 3-day return on each of these 5 variables, 1, 2, 3, 4, 5. And sure enough, we get that this variable is negative. So what does it mean it's negative? Well, that means that if it's a value company, then they care less about, or the market cares less about sales surprises for value firms than they do for growth firms, right? And the way that you know that is because um, this is saying, okay, if it's if value is 1 and quarterly sales, uh, then this is less, right? Then, like, when you add these up, or when you add these up to get the effect of a quarterly sales surprise for value firms, this is going to be less than quarterly sales surprise for growth firms, right? The quarterly sales surprise for, or the 3-day return for quarterly sales surprise for value firms is less than the 3-day return for a quarterly sales surprise for growth firms. And similarly, the quarterly sales, the 3-day return for quarterly earnings surprises for value firms is going to be less than that for growth firms. So basically, if a value firm beats earnings, their 3-day return is going to be less than if a growth firm beats earnings. If that makes any sense. Okay, and so this is the end of this class, but this is basically showing you how to go from the raw data to the to table 1, which is summary statistics, table 2, which is a simple regression, table 3, which is a regression with an interaction term. I hope this was helpful, and I'll see you in the next video.